All right, welcome to this explainer. Today we're taking a really fascinating structured journey right into the financial anatomy of a real estate development. We're going to follow the money, literally step by step, from an empty plot of dirt all the way to a finished, profitable home. If you've ever wondered exactly how developers track every single penny that goes into a build, to ensure they actually make money at the end of the day, well, you are absolutely in the right place. So let's break it down.
We'll kick things off by defining the core engine of our analysis today, which is job order costing. Now, we aren't looking at mass-produced commodities on an assembly line here. We're anchoring all of our math to the physical, unique reality of building a single individual house. Our test subject for today? A project officially labeled OP001, affectionately known as the Residential Centro model. This specific accounting system is kind of like a financial microscope. It allows us to isolate this one house and track every single bag of cement, every hour of labor, and every permit tied exclusively to it.
So, here's our roadmap for today. 1. The project budget. 2. The hidden VAT effect. 3. Accumulating actual costs. 4. Budget versus reality. And finally, 5. The sale and profit.
Okay, let's jump right into part 1, the project budget. Long before a single shovel even hits the earth, developers have to map out their expectations. Set the scene in your mind for a second. We've got a 200 square meter lot, and on it, we're going to build a 150 square meter home. Our preliminary calculations show an estimated total cost of 1,380,000 pesos, with a target sale price of 1.8 million. On paper, assuming the weather holds up and permits don't just miraculously disappear, this promises a highly lucrative profit margin.
So how does that 1.38 million peso budget break down? Well, right out of the gate, materials take up the biggest slice of the financial pie at 580,000. Then we have the land acquisition and prep sitting at 420,000, direct labor at 250,000, and our indirect costs and permits rounding things out at 130,000. This is our baseline, right? This is what success looks like in theory.
Moving on to part 2, the hidden VAT effect. Before we can even start buying materials to pour the foundation, we hit a massive regulatory plot twist. In a typical business scenario, the value-added tax, or VAT, that you pay on your supplies can usually be credited back against the VAT you charge your customers. Pretty standard, right? But according to Article 9 of the Mexican VAT law, the sale of residential property is completely exempt from VAT. You literally don't charge VAT to the homebuyer, and because you don't charge it, you cannot credit back the VAT you paid to your suppliers for the cement, the steel, the bricks. It instantly becomes a sunk cost.
Because of these really strict tax rules, we are left with a crucial, totally unrecoverable number: 80,000 pesos in VAT generated just from purchasing our building materials. This 80,000 isn't magically passed on as some separate tax line to the buyer. No, it is physically and financially built directly into the cost of the house itself. So our materials didn't just cost 500,000, they actually cost 580,000.
Which brings us to part 3, accumulating actual costs.
With those tax rules settled, let's actually watch the financial ledger get built alongside the physical house. This sequence perfectly mirrors reality. First, we acquire the land. Simple enough. Then we enter the active construction phase, which accountants call production and process. This is where all the messy, on-the-ground work happens. Once the paint is dry, it turns into a finished home sitting in our inventory. And finally, the moment we hand the keys over to the buyer, it transforms into cost of goods sold. It's a beautifully simple, logical pipeline that keeps our numbers incredibly organized.
During that crucial production and process phase, the ledger is wildly active. The company is pouring cement, paying the masons, covering overhead site costs. Every single time an invoice is paid or a paycheck is cut, the balance of our work-in-process account drives up. We see the 420,000 for the land, the 580,000 for materials, including that hidden VAT, the 250,000 for our direct labor force, plus the indirect costs and permits. Every single peso is being aggressively funneled into that specific OP001 account.
Now for part 4, budget versus reality.
Okay. The house is physically finished, and now developers have to face the ultimate moment of truth, the final cost analysis. Comparing our initial budget to reality, we absolutely nailed the land cost, and we hit materials right on the head. But then we hit a classic construction curveball. There's a 30,000 peso variance for employer quotas. These are the mandatory Social Security contributions for our workers. In the initial budget, maybe these were assumed to be bundled into the general labor rate, or maybe they were just flat out miscalculated. Whatever the reason, our total cost just jumped from 1.38 million to 1.41 million pesos. Now you might be thinking, well, seeing costs go up is never fun, and you'd be right. But catching this variance is actually a massive victory. It proves exactly why rigorous individual tracking through job order costing matters so much. If we were just lumping all our corporate expenses together into one giant pot, that 30,000 peso slip-up might have just been lost in the noise. By isolating the cost to this one specific house, management can instantly see the discrepancy and fix their budgeting formulas for the next development.
Finally, Part 5, the sale and profit.
The home looks beautiful, and it's finally ready for a buyer. But before we calculate our gross profit, we need to establish our first major operational metric, which is 9,400 pesos. That is our true actual cost per square meter to build this home. We just take our 1.41 million actual cost and divide it by the 150 square meters of construction. This 9,400 peso figure, it's absolute gold. It is the essential foundation for pricing any future development of the Residencial Central model.
And here is the final bottom line. We achieved our target sale price of 1.8 million pesos. We subtract our slightly higher than expected actual cost of 1.41 million, and the result? A really robust gross profit of 390,000 pesos. That represents a 21.67% gross margin. So, despite that 30,000 peso budget variance on the labor taxes, the project remains highly profitable. The system worked, the house sold, and the company made money.
But I want to leave you with this thought. We saw a 30,000 peso variance on a single isolated home. In the grand scheme, it was easily absorbed. But what happens to a company's balance sheet when a developer scales up and makes that exact same budgeting error across a subdivision of 100 homes? Suddenly, that is a 3 million peso hit to the company's cash flow. It's a game changer, and that brilliantly illustrates why tracking every single penny isn't just some exercise in tedious accounting. It is the absolute key to a developer's survival and growth. Thank you so much for joining me on this explainer, and remember to always keep questioning the numbers.